Okay, good evening, everyone. Welcome back to our Beginners Options course. This is part 3 of our Beginners Options Trading course with live market analysis with Q&A. Now, we're obviously at a time where markets are experiencing a lot of volatility. So today, what I actually want to do is spend quite a bit of time taking this opportunity to show you what's currently going on with the markets, what we're currently seeing in the options markets, and really take almost like a crash course in terms of how do you position yourself in this particular market. I'm also going to share with you some of the research that we're currently looking at to understand where the current market stands, what we're currently looking at in terms of research to give us an understanding as to what we expect going forward, what uncertainties we see in the market, and like I said, show you how we can apply what we learned over the last, in part 1 and part 2, to the current market environment. Now, things are moving very, very quickly. So what we're looking at today may be very different tomorrow. So keep that in mind when you're trading these markets. When things are this volatile, you need to make sure that you position very, very quickly, that you look at your portfolio every single day, because a good position today might turn into a bad position tomorrow. So it's really important that you are able to utilize that with your trading. So let's go ahead and get started here. I'm going to try to keep things as simple as possible. Before we do, just a quick disclaimer: everything we're discussing here is purely for demonstration and education purposes, and is not to be taken as recommendation or an offer to buy or sell any specific securities. And lastly, for those of you that are brand new to OptionsPlay, you can sign up for a free version of everything I'm going to show you here today using the tools, using the link here on your chat window. I'm going to post this link to everyone, so if you haven't signed up for OptionsPlay yet, you can sign up for free at optionsplay.se. So we have a lot to cover here today, so let's go ahead and get started. Like I said, today our focus is going to be on the live Q&A, live market analysis with Q&A. So we're going to take as much time as possible today to review what's currently going on at the market, giving you a live analysis of how to apply what we're learning here with the current market outlook, and then giving you an opportunity to ask any questions that you have. Now, this part 3 wraps up our first beginners options trading course. So the next step that we have here is going to be the next options beginners trading course, which starts April 1st. So make sure that you attend that, because what we're going to do is just simply build on what we've learned here in the first beginners trading course and start applying them to real strategies. This first course was really designed around making sure that you understand the concepts of the difference between calls and puts, what an option contract is, and more importantly, the true difference between buying versus selling an option contract. And that's going to come into use during today's webinar. Now, I will talk about some more advanced strategies that we haven't covered yet. So if you're brand new to options trading, this is okay if you don't understand some of these strategies, but today I do want to make sure that we cover some real ways that you can utilize options to trade this current market. We will come back and teach you more about these strategies in upcoming courses. So I hope you guys join me in April, where we're going to talk about adding yield to your portfolio, which is using option selling strategies to add income to your portfolio, and then adding leverage to your portfolio with limited risk, which is buying options to take directional views. And today, what we're actually going to do when we look at the real market is we're actually going to show you how you can combine these two strategies together into a single strategy that allows you to trade the current market that has a lot of volatility, but still take directional views in this market by buying and selling options at the same time. And then what we'll do is we'll revisit this on April 29th. Hopefully markets are more stable by then, and show you again how to utilize the tools to go about doing that. So let's go ahead and turn over to the markets. I want to start off by just giving everyone a bit of an overview of what's currently going on, because as anyone who's been trading the markets recently can tell you, things have been extremely volatile. So what we're really looking for is making sure being able to show you how to trade these markets. So one of the things I want to first say is, obviously, if you follow the OMX S30, we fell from about 1900 down to about 1250 or so to the downside in a very, very fast move. So what we're currently seeing effectively is an accelerated version of what happened in 2008. Meaning we've entered bear market territory in twice the amount of time, in half the amount of time that it took in 2008 for the markets to enter a bear market territory. So most of this has been driven by a few different things, right? The coronavirus is obviously on everyone's minds, but when we look at what factors drove this sell-off, two things really come into play, and that's predominantly the collapse in oil prices and the lack of liquidity that has completely evaporated from the market. So anyone that's been trading, whether you're trading stocks or options, you'll notice that bid-ask spreads are really, really wide because the markets are currently are not very liquid, and they are requesting very, very large bid-ask spreads. And we're seeing this across the board. So if we're looking at the US markets, as you can see, what I have here on the left is a weekly chart of the US markets, and what I have here is the rally from the 2008 lows all the way to the recent highs we had in March. And what you can see here, if you look at a long-term chart, what we see is that the markets have retraced roughly 1/3 of that move, 35% of that move. And right now, this morning, we opened up just around that support level, around 236 or so. That was the support level that we see here over here. So we opened up just at that level, bounced higher, but is now trading back lower around that level. So the 236 level for the US markets are key. If we break below 236, we're likely going to see 213 and 200 to the downside for those of you that follow the US markets. So on the OMX 30, for those of you that are trading OMX S30, the levels that we're currently keeping an eye out for right now is about 1250 or so to the downside. If we break below that, the next support level here is just below 1200, but the ones below that are closer in the 850, 825 level. So there's still a lot of potential downside here. We may see a little bit of a pause here around 1250 or so. But I want everyone to understand that we can still continue to experience quite a bit of volatility going forward. So the question becomes, how do we position ourselves for a few different views here, right? I think there's a view here that you can assume that some users might believe that that 1250 is going to hold and that we're going to get a bounce higher. And some viewers are going to say, I think this market's going to continue heading lower. And I want to show you some other research that we're looking at, some other stats that we're looking at to help position ourselves for this. But before I look at that, I do want to show you some of the indicators that we're currently looking at, some things to keep in mind when you were looking at markets. Volatility is certainly something that we want to look at. This is the S&P 500 volatility. As you can see, we're back to the 2008 highs. So markets are as fearful right now as we were in the middle of the 2008 financial crisis. That is concerning to us, that markets have that much fear. The one, I would say, bright spot, I would say a little bit in the markets today were the fact that Treasury yields, well, let's just take a look at 10-year yields. 10-year yields, despite markets falling, actually rose a little bit. And what this tells me is that the liquidity concerns that we were having over the last few days or the last few weeks is starting to ease a little bit, meaning markets are not in this panic mode of buying safe haven assets, in this particular case, US government bonds, when there simply wasn't enough liquidity. What happened was you got an extreme move in rates. And what we've done now is we've checked back to what I would consider a more normal level, which is good for liquidity. So that's the only bright spot that we currently see in the markets right now. So going back to the equity markets, I just want to bring up some of my notes here so that you guys can see, and I'm going to share these notes with you after we finish here today with the recording here. So again, like I said, what we're currently seeing is an accelerated version of 2008. Now, I do think that this market is scary to trade for a lot of users. However, the one thing I will say is that the price action that we're currently seeing in the market, in my opinion, while it is extreme, in my opinion, should not necessarily be surprising. And the reason I say this is because over the last few years, what we've consistently seen is an environment where we constantly have extreme longer and longer periods of these lower and lower volatility with extreme spikes to the upside, and then followed by another period of longer and lower volatility with an extreme spike. And we're seeing this over and over again. It was never this extreme prior to 2008, but nowadays, this is our new norm. And it's something that we need to come to terms with and make adjustments with, because prior to 2008, what we had was fairly more normalized volatility. We didn't have as much of these long extended periods of low volatility followed by extreme levels of high volatility that we really cannot predict. So it's really important to understand as an options trader, how do you position yourself in this new market environment, in this new norm of volatility, experiencing longer and longer periods of suppressed volatility. A lot of that has to do with the central banks keeping interest rates very low. This suppresses volatility, and then when things break, it causes volatility to spike to very extreme levels compared to the normality or the depressed volatility that we see, and we get these really large moves to the upside. So that is our new norm, and it's really driven this last move. I know we associate this with coronavirus, but notice how when China had a huge growth in coronavirus, markets did not collapse. What actually caused the collapse was really the collapse in oil prices, and as a result of that, the lack of liquidity. So as oil prices collapsed, we had a lot of flow out of equities into fixed income, but the fixed income market simply wasn't liquid enough to absorb all of the outflows out of equities, and that's what caused a huge run on the fixed income markets, and that just became a feedback loop that caused the sell-off that we're currently seeing in the equity market. So volatility remains extremely high. Now, the one thing that I will say as far as options goes, you need to sell options when buying options for directional views. And we're going to talk about how you can go about doing that. How can you buy an option when things are so expensive and volatility is so high by selling options against that to reduce the cost of your trade? Now, the two things that are big unknowns in the market that provide us with, I would say, a lack of understanding as to, in this market, I mentioned that 1250 or so is a major support level here. And the question is, are we going to bounce or are we going to break lower? And I think the big uncertainty that we currently have in the market really pertains to the number of cases of coronavirus and how it grows. So what's good here is the fact that we have a template from China. China has the benefit of being a draconian, of an authoritative government that can isolate their citizens in a way that many democracies cannot. But in that environment, what we have is clear data that shows that after coronavirus starts, it tends to peak about 20 to 23 days after which it starts to taper off. And the net new cases in China right now are virtually zero. And this gives us two data points. Number one, how long does it take for the for containment to happen and for the subsequent tail off? Number two, it also provides us with what is the economic impact to that country during this time. So what we currently have now is the economic data out of February in China, which encompasses this amount of time. So February, during this time, you see economic activity in China decrease by roughly 30 to 40%, which is a huge, huge decline. However, because of the measures that China has taken, what this allows China to do is to start normalizing starting in March, or at least in mid-March, now that the number of net new cases has declined to virtually zero. Now, the question is, are other countries able to follow this type of peak? No, so China peaked after 21 days after it started. Right now, we're looking at Italy to see if Italy follows that same trend. If Italy follows that same trend, that gives us, I would say, hope that the US and other countries in South Korea can follow the same trend as well. However, if the containment in Italy continues to grow for, let's say, 30 days, then this tail becomes much, much longer. So then we can then estimate, well, what is the economic impact to a country? So there's two factors here at play, right? The length of which this virus continues to affect our daily lives and the economic impact to that country as a result of it. Now, you could argue that when there are less draconian measures, things take longer, but the effects during that longer time are slightly reduced, and that may offset each other a little. But that's the data that we're currently looking at as to how other countries are going to peak. So Italy right now is at, I think, 24 or 25 days. And the question is whether Italy will peak and start to decline. If that is the case, that is certainly a good indicator or a good template for what other countries will do. For the US, which is another big center for the virus, 21 days happens to be this upcoming Sunday. So we hope to get a little bit more clarity by Monday of next week, or at least the middle of next week. And by then we'll have a lot of other countries to look at: South Korea, Italy, Iran, US, which are the primary countries that are currently seeing this. And one of the ways that you can track this is the Johns Hopkins Coronavirus Resource Center. They are tracking the number of cases. I will also put a link to this in the chat window for anyone who wants to take a look at this. But I think the chart that we've been looking at for quite some time is this particular chart, the number of net new cases, this yellow line outside of China versus the net new cases in China, which is the orange line. As you can see, that has pretty much flattened out. And the question is whether or not this chart will start to flatten out like we do see here on the orange line. So that's the concern that these are the numbers that we're currently tracking. Those are the types of research reports that we're keeping an eye out on. Like I said, this is a very fluid situation. Things can change very, very quickly. So make sure you keep an eye out on these things while you are trading. So with that, what I want to do is I want to look at some buying and selling call on puts with some real examples, and I'll open this up for Q&A, and I'll open this up for you guys to take a look at some symbols. But I wanted to show you how to position for, let's just say, the OMX 30 continuing to move lower, or for it to bounce starting from where we are here. So let's first take a look at if we think OMX 30 is going to continue moving lower. Like I said, 1250 is a pretty major support level here on OMX S30. If it breaks below that, I would expect that we would see 1180 very quickly, but more likely we could move all the way down to this 1000 psychological level pretty quickly as well. So I want to take a look at how to position for that. So looking at today's closing prices, to buy a May 1340 put option, which is the current put option here, it would cost me 154 crowns, or 15,400 crowns to buy that put option. Now, that puts my break-even price at 1185, which is substantially lower than the current price, meaning the index would have to break below 1250, hit my 1180 target just to break even. So I said 1185 was my first target. So notice how buying a put option for May would just get me to my target price, which in my opinion is too big of a move. So how can we position ourselves to protect ourselves to the downside, but at the same time, perhaps reduce the cost of this trade? And this is really where you're going to have to be a little bit creative. And this is where I want to show you how professionals trade in this particular market. So as expensive as these put options are, it's still important to try to buy yourself protection if you think the market's going to continue lower. And you want to find ways to buy that protection as cheaply as possible. So one of the ways that you can do that is to sell a put against that May 1340. Now, normally we talk about selling a vertical, but in these types of times, it's better to sell what we call a calendar or a diagonal. So what that means is that, so I said that 1250 is a major support level here. So what I can do is I can say, well, what if between now and 2 days from now, or let's say March 27th, a week from now, a week and a half from now, I think that the market is going to go lower, but I don't think it's going to go below 1250. So what I'm doing here is I'm paying 154 crowns for a 1340 put option that gives me all the way out to May, but I can sell an option that expires in just 9 days at the 1250 level for 32 crowns. So I'm reducing the cost of my trade by 20%. I'm reducing the cost of my trade by 20% by selling a 1 week option against my 1340 put option. And the goal here is so that you can buy your put option for a net price of only 122 crowns versus 154 crowns, which reduces your cost of your trade by 20%. Now, if on March 27th, OMX S30 is not below 1250, then what happens is you effectively keep the 32 crowns that you've sold for the 1250 puts for, and what you tried to do is you sell another put against it, and you continuously sell puts to reduce the cost of this put option that you're purchasing, which gives you that long-term bearish view on OMX S30, but continuously reduce the cost of this trade from 154 crowns down to 122 crowns. And maybe the following week you sell another put for 25 crowns and further reduce the cost of this trade so that by the time May 15th comes around, you may have paid close to zero on this particular put. Now, I know that I've covered a lot here on just that one trade alone. So if anyone feels that you don't understand what I just explained here, or if you have a question about trading a calendar like I just explained here, please type one into the chat window, just so I want to make sure everyone understands what I'm doing here when I say let's sell that March 27th 1250 put against the 1340 put and collect 32 crowns here on this particular trade. So please type 1 into the chat window if you understand that strategy, and please type 2 into the chat window if you feel that you don't quite understand that strategy. And you can pull up your chat window at the bottom of your screen. Okay, great. So I see a few ones. Okay, so now let's take a look at what if we're bullish? What if you think that OMX S30, you think that this is a fairly extreme reading here, and you think that 1250 is a good support level, which, if you look at this particular chart, there certainly seems to be quite a bit of history at 1250, right? So I think that it's not crazy to say that things are stabilizing a little bit. The liquidity issues that drove some of the sell-off is easing. So maybe we at least get a small bounce to the upside. Now, let's take a look at how do we position for that. So what we're going to do here is we're going to flip this to a call option. We're going to use, let's say, a 1330 call option. And what we're going to do here, So looking at this to buy a 1320 or 13, let's look at a 1330 call option, which is an at the money call option. This currently costs 120 crowns, right? Which gives me a break-even price of 1449, which is quite high here. If I think that this stock is going to bounce higher, 1449 is all the way up here, which is where we closed in the middle of last week. So if you think that you're going to get a bounce here, but you're concerned that the stock is going to make the index is going to take a slow amount of time to get back up there, that's okay. What we can do is we can also sell a short-term option. Maybe we sell something like let's say 1475, 1480, which is all the way up here. 1475 is that high that we had here on last Friday. So 1475 would collect me 19 crowns. So instead of paying just 120 crowns for that call option, what I can do is I can sell a 1475 for 390. So this is where the bid-ask spreads here are quite extreme here, because as you can see, the spread here is very, very wide. So you need to be really careful when you're trading these, because notice how buying this 1475 is 19 crowns, selling this call option is 390. So the true cost of this bid-ask spread is closer to around 1140. So what I'm doing here is I'm buying the 1330 call option for May, which gives me upside all the way out to May. It cost me 112 crowns. And then what I'm going to do is I'm going to sell the 1475s for next week for 11 crowns. So what that does is it brings my cost down by roughly 10%. And as long as the index doesn't rally above 1475 by March 27th, then I keep the 1140 premium here on the 1475 call option, and I can sell another call option again. If the index is higher, I can sell a higher strike price. If the index continues to move a little bit lower, I can sell a lower strike price. But the goal here is to try to continuously chip away at the cost of buying this May call option. And that is the best way to utilize options in this particular market environment. That allows you to take either a long-term bullish or bearish view, but reduce the cost of that option to take that bullish or bearish view by selling short-term options against that. So I just want to make sure everyone understands that before I move on. Please type 1 into the chat window if that makes sense to you. While I wait for you guys to respond, I will take a look at some of the other trades that I wanted to take a look at. The other one I wanted to take a look at is Telia. This I thought was interesting because Telia has been, fairly range bound for a long time. It's actually still a fairly strong stock here. What we had here was a move immediately to the downside. Let me use this one to be a little bit more clear. We had that move around 40 to about 37, moved a bit higher, had that big move to the downside, now had that rally. We have this huge doji candle here, which in my opinion, I think can be potentially a bearish signal here that suggests that this thing is headed back down to that $30 level. So we want to take a look at how can we utilize options to play Telia on a move back down to about 30 crowns. So buying a $35 put option would cost me 435 crowns. That has break even at basically the target price that I have. So from my perspective, buying this put option is too expensive. This is what we learned in part 2, which is buying a put option is not just bearish, it's bearish by a certain amount. And we need to look at what is the put option trading for to determine how much the stock needs to move. In this particular case, we don't have a lot of the premiums are so high that the break-even price is effectively our target price. So how can we reduce that? So same thing, what we want to do is we want to sell short-dated options. So let's say we sell a 30, let's see. So we're really not receiving much here. So if we buy that $35 put option, first of all, the mid price here is about 3 crowns. So not 5 crowns, but 3 crowns, or 4.5 crowns. It's only 3 crowns. But we can reduce the cost of that trade by 0.9 crowns. So 0.9 divided by 3.1 is 29%. So we're actually reducing the cost of our trade and reducing the risk of our trade by 29% by selling the weekly 33 put option that expires next Friday. So that means that my total on this particular trade is only 220 crowns. So this now my new break-even price here is $34.99. So I'm able to really reduce the cost of this trade substantially by trading this type of what we call a diagonal. Now, for those of you that are brand new to options trading, diagonals may sound scary, they may sound confusing, but in this type of market environment, this is really the only type of strategy that you can trade that allows you to buy optionality, meaning buy options that you think are going to move in the directional view that you have, but do so in a way where you reduce the cost of your trade. Now, this type of trading requires active management because you have to keep an eye out by next Friday whether the stock is below 33 or not. If it's above 33, then these puts will simply expire worthless, and you can sell another put against that next Friday or the following Monday to continuously chip away at the 3 crowns that you have to pay for these May 35 put options. Now, in this crazy market environment where volatility is extremely high, you can actually sell short-dated options that can offset a large amount of the premium that you have to pay on this particular trade. So instead of just reducing your cost by 0.9 crowns, you can actually reduce probably almost the entire 3 crowns between now and the expiration of May, which effectively means that you can buy this the ability for Telia to continue to move lower by May without paying much premium here on this particular trade. So while extreme volatility may be scary, it also provides an opportunity for you to potentially trade strategies that you couldn't trade when things were a little bit more normal. So volatility can really work in both ways. High volatility many times is scary, but it also provides some opportunities here as well. So let's take a look at Ericsson B. This was another trade that we were looking at. Ericsson B, similar setup in my opinion to Telia. Basically what you have here is this big move to the downside from about 90 down to about 60. We've got that retracement here, and the question is whether or not this stock will continue to move lower. In this current market environment, that certainly seems like a potential opportunity here. So here, buying a May 72.5 put, which is the at-the-money put, will cost 960 crowns, which gives me a break-even price of 62.90. Now, let's take a look at the mid price here just to see. So 960 is the ask price, the mid price is 840, which puts my break-even price at 64.10. That's actually not bad here because 64.10 is where the stock was trading just a few days ago. So in my opinion, in this particular case, you might just want to seek a quick move to the downside by just buying a put option if you can get filled at this 840 crowns for this put option, because that's actually not, in my opinion, an expensive way to take a bearish view. Because if this stock declines to, let's say, 60 crowns, which is the low from Friday, if it declines to 60 crowns by, let's say, the end of March, then you're looking at a 66% return on your put option. You can look at this put spread, but like as you can see here, this put spread actually makes you less return if the stock makes a quick move to the downside. So in this particular case, I would advocate that you're better off just using a straight put, because in this particular case, the straight put actually is not that expensive. And that probably is because this stock is up 3%, while the OMX S30 is down 3.5%. So the volatility on this put option is significantly lower than the volatility of some of the other stocks that are down 6, 7, 8% those will have much more expensive put options than the put option that we have here. So there's many ways that you can utilize options to your advantage here, but these are ways that you should be looking at the market for opportunities. Another one I want to pull up here is AstraZeneca. AstraZeneca, similar setup to some of the other names that we're showing up here. Obviously, clearly in a downtrend, it had a small rally here. These are typically the type of opportunities we look at to short. As you can see here, you had one opportunity here where the market went down, rallied back up, and that was your opportunity to get into that short position, moved all the way down, and we've had this rally up here too again. So those are the types of opportunities that you typically want to see on that short. So you have that short, rally back up, that's your opportunity to enter. You had the same rally down here, rally back up, that's your another opportunity to rally for a potential move to the downside. So let's take a look at some put options here. The 805 currently trading at 805. So the March 810 puts will cost you 6,800 crowns, which puts your break-even price at 742, which is right around here. So AstraZeneca, being that it hasn't moved lower today while the markets are down about 3.5%, also means that the put options are not that expensive. So 740 is where it was trading on Friday. So if this stock just simply went back to where it was trading on Friday or lower, back to that 707 level, let's take a look at our P&L simulator and say, what happens if AstraZeneca revisits that $700 level, but does so by the end of March? As you can see here, you're looking at an 86% return on just the straight put. So in this particular environment, I would advocate that you might just want to take a look at selling an individual put. You can add to the put option what I just showed you here before, but let's just take a look and say, what happens if you sold, let's say, a 705 put against it? So you're paying 68 crowns for the 810 put. You're collecting about 780 on the 705 puts that expire next Friday. That might actually not be a bad trade. So you're basically selling something that has a very low probability of being in the money, collecting 9 crowns, which offsets the cost of your trade by 64 crowns. So if the stock does go down to 700 crowns by the end of March, you're looking at about 121% return because you've reduced your cost from 64 crowns now down to 55 crowns. And that increases your return from around 80% to about 121%. So I'm just showing you these examples to give you an understanding as to how you can utilize options to your benefit in this particular market environment. But I will say this type of strategy requires very active management. It requires you to keep track of where the market is on every single stock, whether it's above or below that strike price that you sold. So in this particular case, 705, you need to make sure by next Friday, you look at whether the stock is above 705 or not. If it's above 705, these puts will expire worthless. You can continue to sell another put. But if they are below 705, if the stock is below 705, then what you need to make sure is that you buy back this put so that you can continue to maintain your long-term exposure to the downside. So it's a more advanced strategy, but this is the type of strategy that would be required to trade in these types of extreme volatility environments. So with that, I just want to thank everyone for taking the time out here this evening. I hope that this was helpful in giving you a better understanding as to what's currently going on in the markets, giving you a better understanding as to how to go about positioning yourself for these types of markets, and giving you a glimpse into how professionals are currently trading this type of market environment, because it is a challenging environment, but that this type of extreme volatility provides a double-sided opportunity from the perspective of you can get moves that happen very quickly, and at the same time, what you can do is you can sell some of that extreme volatility, these short-dated options that can offset a very large percentage of the longer-term views that you may have on the underlying stock. So when you're buying, you always want to buy at the money options that expire at least 30 days or more. So in this particular case, I'm buying a 58-day option. I'm buying an at the money put because I'm bearish. And then what I want to do is I always want to sell a very short term, in this particular case, 9-day option that is out of the money here. That's why I'm selling that 705 put option. So that is the way to position yourself in this particular market. It is a challenging market to trade, but if you can be diligent and you are actively managing your portfolio, this is how you can go about utilizing options to your advantage during these types of volatile times. So with that, I want to thank everyone again for taking the time out here this evening. I hope that you guys have found this useful in your understanding of options and also understanding of how to utilize options play to analyze your strategies and position for different outlooks that you might have in the markets, whether that's a bullish view on OMX and you think the markets are going to bounce, or you think the markets are going to continue moving lower. You can utilize options for both directional views. So with that, I will open this up for Q&A. If you have any questions regarding anything I went over here today, please type them into the chat window and I will answer any questions that you might have regarding this market, regarding volatility, regarding options play. I'm happy to answer any of those questions that you might have. Just type them into the chat window and I will spend as much time as possible to answer your questions. And just a reminder, I will send everyone here the slides so that you can have the notes that I have posted as far as what we're currently seeing in the markets. I will also include the links to the tools that we're currently utilizing to track the situation that we're currently seeing with the coronavirus, this Johns Hopkins tracker, which I think has been extremely helpful in understanding the fear that many people are currently having in this market. Okay, so one of the questions is the link here. So I just sent the link to everyone here in the chat window. I'll post it here again for this. Another question is, where do we currently get this research in the Corona Tracker? This is a Bank of America research piece here in the United States that has been tracking these coronavirus cases. However, you can always use this Johns Hopkins to track how many new cases in each country every single day. This gives you a better understanding as to how you can utilize this tool to give you data that some of the investment banks are currently using to track this type of information. But again, I think the most important thing is that China peaked in the daily count on 21 days. Lombardy, Italy, which is the center in Italy, was 23 days. So we just need to make sure that that trend continues in other countries. If that trend does continue in other countries, that gives us an understanding as to how long this pandemic can last for. And I think that's important for us to understand the economic impact. You know, we do already have data out of China as to how much their economy slowed in the month of February, which is the bulk of the February is from this time to this time. As you can see, that is the bulk of the number of cases. So during that time, economic activity slowed by about 30 to 40% based on some early economic indicators that we have to look at. That can be our template for other countries as well. I do expect economic activity in the US and other developed countries to be a little less than 30 to 40% because China did have some draconian measures to slow down their economy, which did drastically reduce the number of cases. So I expect that in other countries, things will last a little longer, but the economic impact will be a little less severe. Okay, so again, thank you so much everyone for taking the time out here this evening. Again, I hope that this was useful for you to better understand how to position yourself for this market. It is a volatile time. Be careful. Don't panic, because you can utilize options to take these directional views with limited risk. That is the best advice that I have for you with this type of market, is that when you have these big moves to the downside, a lot of people tend to panic and they sell their positions. Try to be counterintuitive here when it comes to these types of big moves ups. When you get the big moves to the downside, those can present themselves potentially as buying opportunities, many short-lived opportunities, but they are still opportunities to potentially buy. And then when you have big moves up like we did yesterday, those are potential opportunities to sell. It's a very counterintuitive way to go about of looking at the markets, but many times the contrarian view is what provides us with the best returns. And a lot of data that we currently have in the markets show us that. So with that, again, thank you so much. I hope you guys have a great evening. Stay safe. And I will see you guys on April 1st for our next part 1 of our next options master course. Have a great evening, and I will send the recording out to everyone in a few minutes.